All right. Well, we've got a new week ahead, everybody. Welcome to Finom Group's weekly free video. And hope everybody has a great trading week. Over the weekend, I decided to write a quick blog. I don't do a lot of blogging because I am usually doing our Phenom Group weekend research report as well as state of the market videos during the course of the week. So I don't really have a lot of time to post any free blogs, but this turned out to be one of my, if not the most popular blog that I've written over the last 5 years or so. So for all of you who read my blog over the weekend, very much appreciated. For those of you who shared it, thank you as well. It did actually pick up a lot of coverage. I've seen it now in 4 or 5 different YouTube videos or charts from within this blog. So again, thank you. Hope you found it value added to your process. But I also recognize that a lot of folks don't want to do reading over the weekend. So I figured I'd do this video to kind of cover what I discussed in the weekend blog. And sometimes it helps to add some context to some of the charts, some of the data, and what have you. So with that being said, let's dive into it. And again, hope everybody has a great trading week. If you're not a member of Phenom Group, if you don't have access to our weekend research reports, our macro market research reports, our data, littered through all of our reports on our website platform, you will be able to access at your fingertips a treasure trove of quantitative studies, economic data, technical analysis, so on and so forth. So if you're not already a member, do consider joining one of our paid research programs. Our contributor membership gives you access to all of our research weekly videos. And if you want to trade, invest with us, our ideas that we generate on a daily and weekly basis, our premium membership is $59.99 a month. I think most of our members will tell you that you'll pay for your subscription within the first week for the full year. So anyways, all right, let's dive into it. So how I started off our weekend blog was kind of reiterating some of the things that were found, some of the analysis that was found in our previous weekend research report. 2 weeks ago, this was our macro market research report that I was referencing, August 20th. The title being From Good Overbought to Good Oversold. Well, what makes good oversold conditions? We think about it practically as active portfolio managers. If you can identify good oversold conditions, you can facilitate a really strong trading acumen and probable outcome. So one of the things that we discussed in that weekend report was the S&P 500's McClellan oscillator. And we understood that based on the negative 100 reading on what is that, August 16th, this was technically a buy signal. We were in oversold conditions that over the last 4 years we have not seen but for a handful of time. And every single time, this was a buying opportunity. Sometimes you had to wait longer than others, but on average, the S&P 500 generated a 4% rally off of this McClellan oscillator reading. So we understood there was a trading opportunity there. Again, going back to our macro market research report, and as you can see, a lot of data, a lot of quantitative studies from around the various institutions that we include in our macro market research reports. Let's see. Again, technical analysis, overbought, over. So my chart, which I tweeted out, for or X'd it out, I posted on X, just trying to get comfortable with the new pronouns, if you will, for that platform. And Yeah, it actually got picked up by Fundstrat's Tom Lee in his daily articles, and I find that to be, hey, if it's in Tom Lee and Fundstrat's daily articles, you're probably looking at the right things. But again, this goes back to the 16th when I posted this analysis, and lo and behold, right, we had more than a 2% rally off of that deeply oversold McClellan oscillator reading. So just kind of reviewing what we said in the past and looking at some of the additional data tied to the McClellan oscillator. Generally, it's telling you you're within the bottoming phase. If you have not already bottomed from some type of corrective activity, consolidation in price, you're within the realms of a bottom typically. And this goes back to 1990. This from Fundstrat. When you've crossed negative 50 on the McClellan oscillator for the S&P 500, more often than not, 72% of the time, you are bottoming within 15 days. That corrective wave, that price consolidation was in the bottoming stage. One of the other studies, from within the macro market research report that we reviewed in this weekend's blog, was the equity-only put-call ratio, which also spiked above 1. And here's the 3-month forward performance for the S&P 500 after the put-call ratio jumps to 1.0 or better. And as you can see, 3 months later, and this goes back to 2014, 3 months later, it's positive return every single time. In fact, the average return is 11.8%. Notice, however, the lows, right? So there was more downside in most every single occurrence. But 3 months later, you still generated a positive return. And a couple of weeks ago, we did jump above 1.0 on the equity-only put-call ratio. So again, this is a lot of oversold conditions that we identified in our macro market research report and reviewed in this weekend's blog. So fast forward, when we look at this kind of data, we want to say to ourselves, most data that you'll find, most headlines that you're listening to, most programming in the financial media doesn't lend itself practically. There's nothing to do with it. More often than not, you're going to hurt yourself if you try to use it practically. When I am considering the most practical form of technicals and or quantitative studies, it's identifying oversold conditions. Why? Why not overbought conditions? Well, typically the market is going up over time. 75% of all annual return years are positive, generating a positive return. So what we are trying to really identify from a practical perspective is, where are those buying opportunities? Oversold conditions are practical buying opportunities. You can use them. Headlines, not really useful. Financial media, nonsense, not very useful. Overbought conditions, you want to be careful with, of course, leaving too much money on the table, i.e., you're overbought. People think, well, I should automatically sell. I should start hedging my portfolio. And then we just get more and more and more overbought. Rarely, very rarely do you get more and more and more oversold. Very rarely. Typically happens at the onset or the commencement of bear markets, which are rare, far and few between. So what this chart is basically identifying is that don't be a market timer. When we're looking for useful data, we're mostly looking for ways to allocate to the market, increase our leverage. We're not looking to time the tops. We're not looking to time overbought conditions. You want to stay in the market. You like your stocks, you like your sector ETFs, stick with them. Fundamentals haven't changed. Don't worry about overbought conditions. Worry about finding oversold conditions during consolidation phases. So those areas of the market that you wish you had more leverage in, you can take advantage and allocate capital. All right, moving on. So we've known for a while now that we're in this kind of chop and slop period, as evidenced by the S&P 500 cycle composite for 2023. Every year, Ned Davis Research puts out the cycle composite for that particular calendar year, for that particular index. They do it for the NASDAQ as well. And wouldn't you know it, here was July, and just in July, we tend to peak out. And this is based on the equal weight on a 1 year, 4 year, and 10-year period, decennial cycles, presidential cycles, and 1 year seasonal cycle. And sure enough, we did top out in July, and we have pushed lower here in August. Now, typically coming out of August into September, you start to hit that uptrend, but it may not be the ultimate low here for the Q3 period, which tends to happen right at the end of September. So we may have a nice rally. We've followed the path pretty well throughout the course of the year. You'll have these varying degrees of magnitude along the path that the S&P 500 is generating a move. Like here, a much bigger move than according to the cycle composite index. Like here, a much bigger correction than according to the cycle composite index, and then a climb. So we're traveling the same path. So we have to respect this particular analog, if you will, until proven otherwise. Analogs are not supposed to be perfect. On this day, the analog goes down, so should the S&P 500 for this calendar year. It doesn't necessarily work perfectly like that throughout the cycle. So do keep that in mind. All right, moving on. As I was speaking to the put-call ratio earlier, there are people that look at the VIX and say that's the best gauge of sentiment in the market. I don't particularly believe so because, the VIX can spike or plunge for a great many reasons. And then there's calendar issues associated with the VIX that a lot of people aren't familiar with or don't care to recognize. But the reality is, when you have institutions conforming to a calendar type pattern, you have to appreciate it. What am I referring to? Well, there's 2 days in the week where the VIX is manifesting in depicting a operation that started at the beginning of the week. So on Monday, most portfolio managers, large institutions, that's their weekly hedge day, and it's automatic. Okay, so they're putting on leveraged hedges against their long portfolio, and usually they're hedging about 2 to 3% of their long exposure to the market. It's automatic, happens every Monday. It's why more often than not, aside from the VIX resetting from lowered options bids on the previous Friday, that the VIX is up in the morning almost every single Monday. Those automatic hedging programs and the resetting of the VIX from the lowered options bid the prior Friday. So if we're putting on weekly hedges on Monday, what do you think is happening on Friday? Those weekly hedges are rolling off, which is why more than 65% of the time, the VIX is down on Friday. They call it VIX Crush Friday for a reason. So these are market operations or portfolio manager operations that are technically guiding the VIX. It's not really a true gauge of risk appetite or volatility even. It's operations. So that's why I say the VIX is not always a good measure of sentiment, risk appetite, if you will. I prefer the put-call ratio when I'm looking for sentiment. Are they buying more calls or are they buying more puts? And that's what this chart shows also. This is about regimes. This chart is color-coded to show you the different regimes. I'm using the 10-day put-call ratio for the 10-day equity-only put-call ratio here to evidence and identify how market sentiment works. It generally works in regimes. We had a 2-year downtrend in the 10-day put-call ratio, 2-year downtrend that troughed there in late 2020, and then we went on a 2-year uptrend in the 10-day put call ratio. And now we're back in a downtrend, meaning that they are buying fewer puts and likely buying more calls. Risk appetite has generated or regenerated anew, favoring long equity exposure. So more recently, what did we also evidence? In the past, we looked at the put call ratio itself, the equity put call ratio jumping above 1. But looking at the 10-day equity put call ratio, it got above 0.80. And that's another threshold level that we look at. Longer time frame, right? This is 10-day put call. So that's basically 2 trading weeks, and it gets above 0.80, but a handful of times. And this goes actually all the way back to 2010. So just after the great financial crisis, the start of a new bull market, every single time the 10-day put call ratio gets to 0.80 or better, it's been happening at a corrective low, and then the market takes off. Here it is, a corrective low, the market takes off. Corrective low, rally, corrective low again. That was 2015, 2016, kind of a double bottom. The last real, W-shaped bottom we've had. But as you can see, market takes off again. 0.80 in 2019, and then market takes off. This is the S&P 500 in the bottom panel. The equity put call ratio, 10-day equity put call ratio in the upper panel. Of course, last year's bear market gets above 0.80 and very much above 0.80. That was a rough patch, obviously, but the market has taken off since. So here we are again, possibly a corrective low, or at least bottoming near a low. We're not trying to pinpoint the precise bottom. You get into that business, it's a bad business to be in. What we're identifying here are oversold conditions, areas where you want to take advantage of what the market is producing, which is value. Don't worry about calling the exact bottom. Worry about capturing value. Because after each of these signals going back, in fact, the last time this signal failed was during the financial crisis. All right, so and here you go. This was a tweet I put on August 16th, so a couple weeks ago. And we talk about this in the Finom Group trading room. We're identifying these oversold conditions. You may see stuff on Twitter that we've already taken action on, right? Because I'm generally hands-on. We're talking in the trading room with our Finom Group Premium and Mastermind Options members. Oversold conditions in bonds and equities. Confluence of factors produced conditions which likely prove temporary and favor savvy investors seeking value as the macro backdrop projects favorably. What does that mean? The economic data is good. It's not signaling a recession. More than likely, if the economy is growing, earnings are going to grow. We've already seen 2 straight quarters of pretty significant beats when it comes to earnings estimates, and that has continued through this earnings season. And by all accounts, if the Q3 GDP continues to show what it's been showing to date, then we're probably going to see continued beats in the Q3 earnings season, which starts, I think, in November. Don't hold me to that. But bottom line, I'm in recapture buy mode. See a lot of positions, trading positions mostly. I have been selling as the market was trading higher into and through July. It enables this correction, this consolidation phase enables me to recapture those trading positions and decide whether or not I want to add long-term leverage, in buy mode during this these oversold conditions that have developed in the market. We have a 5-month win streak leading up to August, but by all accounts, unless we have, close to a 4.5% rally here in the next couple of trading days, because that's all we've got left here on August 28th, this 5-month winning streak is going to break. What does that mean going forward? Well, that's something that I'll be discussing with our Finom Group members in the trading room. Nonetheless, when we think about this current environment, this new bull market, right? as confirmed by returns following a 20% advance off of a bear market low, which has happened. We were more than 23 or 24% off of the bear market low from October 22nd. 12 months later, after that kind of occurrence, 12 months later, only one time was the market red, and that was 2001. Every other time, look at these gains. 12 months later, so that's 12 months after the signal. The signal came on June 8th, 2023. So looking forward to June 8th, 2024, the market has been up more than 92% of the time. Only one time was it negative. Look at the average returns after the signal date, folks. It's almost 19% average return, 18.5% median return. The probabilities that this bull market is going to just all of a sudden roll over are extremely low. Here's another study that we've talked about, the OECD composite leading indicators for the United States. Kind of, again, this is a more macroeconomic type of study, and well, buy, right? I think it speaks for itself. When we've turned higher in the OECD composite leading indicators, which actually started in June, but now we're almost at 100%. Historically, 2 months after the signal, 2 months after the signal date, and the signal date was on July 31st, 2 months later, keep in mind, folks, July 31st, the S&P 500 topped out on a closing basis at 45.88. 2 months later, after the signal from this study by the sentiment trader, the market was higher 100% of the time. It has never been lower. Do you think that we might have pulled a lot of the September swoon weakness, right? September being the worst month of the calendar year for S&P 500 returns, and has actually delivered a negative return on average since 1950. We are down like 4.5% this month in August. I'm thinking we might have pulled forward a lot of that September swoon weakness into the month of August. 100% of the time, 2 months after this OECD leading economic indicators signal fires, because we've turned nicely higher, the market was positive 100% of the time. The median return is 5.3%. We're down 4.5%. If all things add up, we're looking at new highs late September. So do keep this study in mind. One of the things that is on my radar, maybe has not been discussed, it's kind of gone, what do you call it? What's the word? Uncovered? Yeah, it's not been covered by the media. It sounds like a bad word, uncovered. Anyways, maybe I watched too much Dateline. Uncovered the secrets of this murder, right? But we might have a government shutdown still, folks. Remember what we passed, the legislation that passed that enabled us to raise the debt ceiling last go around, only kicked the can down the road to September. So we do have to be cognizant of that potential geopolitical factor or domestic political factor ahead of us. This study here is forward returns of the S&P 500 at the start of a government shutdown. So 3 months after, 6 months after, 12 months after. There's not a lot here so far, probabilities are concerned, which leads me to believe that the government shutdown doesn't really offer a viable, probable, or a probabilistic outcome. The market is looking at other stuff, so to speak. All right, folks, I think that's all I got for this week. I hope you enjoyed this coverage of this weekend's blog. Again, if you don't already have your Finom group contributor membership or premium membership, do consider subscribing today and join us throughout the remainder of this calendar trading year. Have a great trading week, everybody. Take care.